Hi, my name is Margaret Cassar, and for my research topic, I chose non-qualified deferred compensation plans. And my question was, to what extent is non-qualified deferred compensation paid to a service provider permitted under Section 409A of the Internal Revenue Code? In the case United States v. Brodnick, the defendant adopted a non-qualified deferred compensation program. He claimed that he thought the plans were legal and legitimate. Unfortunately, with the enactment of Section 409A of the Internal Revenue Code, his actions were unlawful because he did not record the amounts in gross income. Under Section 409A, the extent of non-qualified deferred compensation paid to a service provider is not limited, but there are extensive rules and regulations. In 2004, Congress put forth new rules to respond to mistreatment with deferred compensation. These rules are intended to prevent abuse by executives regarding deferred compensation and severance, such as the WorldCom and Enron bankruptcies. Section 409A provides election, distribution, and funding requirements with respect to non-qualified deferred compensation arrangements. According to this section, the term non-qualified deferred compensation is defined as any plan that provides for the deferral of compensation other than a qualified employer. All compensation for the taxable year must be included in taxable income under all circumstances. Failure to include the amount in gross income can cause an additional penalty equal to 20% of the compensation that should have been included in the gross income. In general, requirements are met if the plan provides that compensation for service performed during the taxable year may be deferred at the service provider's decision only if the decision to defer the compensation is made no later than the close of the preceding taxable year. In order to determine the amount that is permitted under Section 409A of the IRC, the type of plan needs to be determined. Section 409A and Section 1.409A1C of the final Treasury regulations define the term plan to mean any agreement, method, program, or other arrangement, including an agreement, method, program that applies to one person or individual. A plan may be adopted by the service recipient or may be negotiated or agreed to by a service recipient and one or more service providers or service provider representatives. One of the final Treasury regulations provides that for non-account balance plans, the amount of compensation deferred before January 1st, 2005 equals the present value as of December 31st, 2004. The amount then equals the payment to which the service provider would be entitled under the plan if the service providers voluntarily terminated services without cause on December 31st, 2004. The service provider must have received a payment of benefits available from the plan on the earliest date allowed and receive the compensation in a form with the maximum value. Section 409A for account balance plans states that the amount of compensation deferred before January 1st, 2005 equals the portion of the account balance of the service provider as of December 31st, 2004. The service provider then has the right to which is earned and vested as of December 31st, 2004, plus any future contributions to the account, the right to which was earned and vested as of December 1st, 2004. Also, one of the final Treasury regulations, a deferral of compensation does not occur if compensation is actually or constructively received by a service provider by the later of the 15th day of the third month after the end of the service provider's first taxable year in which the amount is no longer subject to substantial risk of forfeiture, or the 15th day of the third month after the end of the service recipient's first taxable year in which the amount is no longer subject to a substantial risk of forfeiture. For tax purposes, the executive does not include the deferred amount in gross income until it's actually paid out to the executive. The company does not claim a deduction for the deferred amount until the executive includes it in gross income. During the deferral period, earnings on the deferred amount generally remain taxable to the company. Therefore, the law imposes a tax tension between the executive and the company because every dollar for which the executive defers income is a dollar for which the company must defer its deductions. In conclusion, Section 409A of the Internal Revenue Code focuses on three aspects of non-qualified deferred compensation. 1. The timing of deferral elections. 2. The timing of distribution. And 3. Funding arrangements that limit the risk of non-payment in unacceptable ways. Under Section 409A, the amount paid to a service provider is not limited with the non-qualified deferred compensation plan. However, the tax consequences to both the service provider and the employer are extremely strict. Failure to satisfy the new rules with respect to any plan participant results in inclusion in the plan participant's income of the deferred compensation to the extent that the amount is not conditioned on future performance of substantial services by any individual, an increased underpayment interest rate, and additional 20% tax. Thank you.